Good day, my student. Welcome to Manifested Online Classes. My name is Joseph Kemani. In this session, I want us we look on some illustration questions on the topic of income taxes. I want us we look on a number of illustrations so that you can be able to understand how we compute the current tax and the deferred tax. So here we have a number of questions from the past papers. We have the question for April 2023, question 5A. We also have another question for May 2018, question number 1B. So these are theory questions coming from that topic of income tax. So I want to give those particular two questions as an assignment. And equally, if or once you attempt those particular questions, maybe you have a challenge, I usually encourage my student to acquire this revision kit prepared by Manifested Publishers so that you can be able to counter check the solution for the same. So therefore, make sure you attempt those two questions there, which are theory question. Then from there, I want us now we do this particular question here for April 2023, which is question number 5B, and which is a computation question. So let's go through that question there, and it reads, BXL Manufacturers Limited, a small firm engaged in the production of fertilizer, purchased an item of equipment for shillings 12 million on 1st July 2018. The company provides depreciation on equipment on a straight line basis at the rate of 25% per annum during the 4 years from 1st July 2018 to 30th of June 2022. The profit after tax and allowed wear and tear charges for tax purpose were as follows. So we are given 4 years there, or basically we are given information for 4 years from 1st July 2018 to 30th of June 2022. First of all, we have the profit after tax. So that particular profit there was a small error with that question. That was supposed to be profit before tax, because you can see in the requirement down there, we are required to compute the tax. We are required to compute now the taxable what? Profit. So therefore, what we are given there, that was supposed to be profit before what? Tax. And then we have now the allowable wear and tear charges. This what in other terms we refer to as the capital allowances. So we are given the profit before tax actually for the 4 years, and also we are given now the rates of computing the allowable wear and tear charges. Then from there we are told the corporate tax for the period of 4 years remained at the rate of 30%. And then what you are required from this particular information one is for each of the year which ended 30th of June 2019, 2020, 2021, and 2022. Number one, we compute the taxable profit, and number two, we compute the deferred tax. We compute the deferred tax. So we can start with the Roman 1, whereby we are required to compute now the taxable profit. But I think before we do that, there are some items, two items we need to compute, because we are going to use them in terms of computing the taxable profit. Number one, we can compute the depreciation, because we are given information about depreciation there. So let's compute the annual depreciation per annum. And what you are told is that the depreciation here on the equipment which was acquired as per the information we have in paragraph 1, that equipment had a cost of 12 million. And you're told that this company is depreciating that particular equipment at the rate of 25% using straight line method. We have to recall here, at the straight line method, depreciation is computed based on the cost. So therefore, to compute this particular depreciation, we take now the rate which you are given times the cost of this equipment. The cost of the equipment in our case is 12 million. So we get 25% of that, which is basically the same with a quarter, and that will give us 3 million. So meaning that the depreciation per annum of this particular equipment, or basically the depreciation of each year for the next 4 years, will be shillings 3 million per annum. So that is the depreciation. Then from there we need to compute the wear and tear allowances. allowances. Remember, in this case, we have said that this is also known as the capital allowance. The capital allowance, or in other terms, we refer to this as the capital deduction. Capital deduction. So for the period of 4 years, we are given the rate of computing that particular wear and tear allowances. In year 1, which is now the year 2019, we are told it is 40%, and basically this should be 40% of the cost of this particular equipment which was acquired. So we know that the cost of the equipment which was acquired was 12 million. In the year 2020, it is 30% of 12 million. And then in the other year, which is the year 2021, the rate there is 20%, and it should be 20% of the cost of the equipment, which is 12 million. And the year 2022, the rate is 10% times 12 million, times 12 million. So we need to compute this particular capital allowances, because we need this information in computing what is required in Roman 1 and also Roman 2 of that question. So the capital allowance for the first year is 40% of 12 million, and that will give us 4.8 million, 4,800,000. So in the other year, which is year 2, it is 30%, which will give us shillings 3.6 million. And then the other year there is that is the year 2021. It is 20% of 12 million, and that will give us what? That will give us okay, we can retake that again. 20% of 12 million. Yes, that will give us 2.4 million, and 10% of that will be 1.2 million. 1.2 million. So these are the capital allowances as far as this particular equipment is concerned. Now, the first thing we need to recall here is that this particular capital allowances, or this wear and tear allowances, these are allowable expenses. But on the other hand, we know that depreciation, this one, is a disallowable expense. So therefore, if you check on what we are required to compute in Roman 1, we are required to compute now the taxable profit. We are required to compute the taxable profit. So how do we compute this particular profit here, the taxable profit? To compute the taxable profit, we take the accounting profit which is given there. The accounting profit, in other terms, is the profit before tax. Remember, I've said that question had a slight problem, a slight typing error. So that was supposed to be profit before tax and not profit after tax. So we take that profit before what? Before tax. And then to this, we add back the disallowable expenses, disallowable expenses. So when we talk about the disallowable expenses, these are those particular expenses which are deducted in arriving at this particular profit, but they are not supposed to be deducted in accordance with the tax laws. So what we do is that we add them back, and then we less allowable expenses which have not been deducted in arriving at this particular profit. Now, in this particular question here, we only have one allowable expense, and that is now the wear and tear allowance, or the capital allowance. Now, for taxation purpose, capital allowances, this is allowable expense. Whenever a company is computing the taxable profit, the company should deduct this particular capital allowances. But always, in arriving at the accounting profit, those particular capital allowances will not have been deducted. On the other hand, Here we only have one desirable expense, and that is what? The depreciation. And the reason why we are adding that, adding back that particular depreciation is because in arriving at the profit before tax which you are given there, depreciation has already been deducted, but according to the existing tax rules, depreciation is desirable what? Expense. So therefore, what we need to do, we need to have various columns here for the years which are given. I hope you can see we are given information about 4 years, 2019 up to 2021. So we have years here, 2019, 2020, 2021, and then 2022. The figures we are given there are in thousands of shillings. So we need to indicate that all our figures will be in thousands of shillings. Will be in thousands of what? Of shillings. That what we need to have first of all here. And then we need to start with the profit. Remember, I've said to compute this taxable profit, we need to start with the accounting profit. Accounting profit, I've said, is the same with the profit before tax. That is what you're given, and that's what you're going to start with here. The profit before tax. And then in this case, we are saying to this particular profit, we are going to add back what? Desirable expense. And basically, I've said the desirable expense which we have in this particular question is what? Is depreciation. But before you do that, let's have the profit before tax, which you're given. Say in the first year, it was 2,400. Then the other year was 27. The other year was 2,850. And finally, we have 2,550. That is the profit before tax, which is the same with the accounting what? Profit. And then now to this, what do we need to do? We need to add back the desirable expense, which has already been deducted in arriving at this profit, and that is the depreciation. Remember, you have computed the depreciation per annum here, which is an amount of 3 million, and basically this is per annum. The depreciation for 2019, 3 million. For this year, 3 million. 2021, 3 million, and that year 3 million. So we add back that, and then to this now we less the allowable expenses, which are allowable expenses which have not been deducted in arriving at this profit. It is this capital allowance, or these wear and tear allowances. So we less wear and tear allowances. So for the first year is 4,800. So, but remember our figures are in thousands of shillings. We are going to take that as 4,800. And then for the other year is 36. The other year here is what? Is 2,400. And then finally here we have what? 1,200. We have 1,200. So after doing that, now what you're going to determine, or basically to get down here, is the taxable profit. Is the taxable profit. So let's compute this taxable profit, starting with the first year. In the first year, we have 2,400 plus 3,000 minus 4,800, which will give us a taxable profit here. Taxable profit of 600. And then we have 27 in the year 2020 plus 3,000 minus 3,600. 3,600, which will give us 21. Which will give us 21. Okay, let me counter check this whether that is correct. I've said we have 24 plus 3,000 plus 3,000 minus 48. Yes, that is okay. It is 600. So let's go to the year 2021. We have 2,850 plus 3,000 minus 2,400. So this will give us 3450, 3450, and finally we have 2550, 2550 plus 3,000 minus 1,200. So that will give us what? Will give us 43, 50. 43 what? 50. So this is now what the examiner was requiring. You are required to compute that that what? Taxable profit. A taxable profit. So let's move to Roman 2 of that question. Roman 2 of that particular question, we are required to compute what? We are required to compute the deferred tax. We are required to compute the deferred tax. The deferred tax. So what is the deferred tax? Remember, in this case, we have said that deferred tax is basically the tax which will be payable or recovered by the company in the future. And mostly we said, or actually we say deferred tax arises due to the difference between accounting profit and taxable profit. Accounting profit and taxable what? Profit. So what we need to do here for us to compute the deferred tax, we need first of all to compute something called the timing difference. The timing difference. So what is the timing difference? The timing difference, this is the difference between accounting profit and taxable profit, which give rise to deferred tax. I hope you can see in our case, we already have the accounting profit. Remember, accounting profit is the same with the profit before tax. So whatever you have here, this is what? This is the accounting profit or the profit before tax. And at the same time, you can see we have what? The taxable profit. Now, if you compare these two profit here, accounting profit, taxable profit for the period of 4 years, you can see that profit is not the same. So once those two profits are not the same, then we are saying that automatically will give rise now to deferred what? Tax. So therefore, we compute the timing difference as the difference between accounting profit and taxable profit. And then to determine now the amount of deferred tax, we multiply that with the tax rate. We multiply that with the tax rate. So let's have that summary here. We are going to compute the deferred tax for the 4 years. We start with 2019, 2020, 2021, 2022. So what we need to do here is to have the two profits. We can start with the accounting profit. Accounting profit, you have to remember, is the same with what? Is the same with the profit before a tax. And then we have the taxable profit. The taxable profit. The difference between these two profit is what you are referring to as the timing difference. Timing difference. We are going to have now the other column there for the timing what? Difference. And also our figures here are in thousands of shillings. Our figures are in thousands of shillings. So these are quite simple now. We just need to transfer what you have here. So let's first of all have the accounting profit. The accounting profit for the first year is 24. What we have here, 27. Then here we have 28 what? 28.50. And then we have what? We have 25.50. 25 what? 50. 25.50. Then we have the taxable profit. The taxable profit is what you have computed here. 600, 2100, 24.50, and then 43.50. So what we just need to do here is to get now the difference between those two what? Figures, the accounting profit, taxable profit, and the difference now will be what? Will be the timing difference. Will be the timing difference. And then once we compute that timing difference, we have said to compute the amount of deferred tax as required in the question, we just take the timing difference times what? The tax rate. So meaning that here we also need to have another column here for deferred tax. For deferred what? Deferred tax. And basically this deferred tax will either be a deferred tax expense or a deferred tax income. So any figure which is basically a negative figure here will be a deferred tax what? A deferred tax income. So let's get the difference here first of all. This minus this will be 1800, which is a positive figure. This minus this will give us 600. And then this minus this Okay, these should be what? Let me take 27 minus 21. That will give us 600. 600. And then we have this minus that. 2850 minus 2450, which is 400. And then this minus that, which is 2550 minus 4350, which will give us what? Which will give us 18 what? 1800. But this 1800 you can see is a negative. Is a is a negative, yes. And also this figure, there is a figure we have recorded longer here. This should be, this is 3400, not 24. Yes, so let's compute that afresh. We have 2850 minus 3450. Yes, this will be negative 600, not positive 400. This will be negative 600. So having that, then what do we need to do finally? We need to compute the amount of deferred tax. So the deferred tax, we take the timing difference, which we have here, times the tax rate. I hope you can remember in that question we are told the tax rate for this company for the period of 4 years. In the last paragraph, we are told is 30%. 30%. Tax rate in our case is 30%. So we take this timing difference times the tax rate. So in the first year, we have 1800 times 30%. That will give us a 540. And a positive figure here is a deferred tax expense. A negative figure is a deferred tax income. So we do the same here. We take our timing difference times the tax rate. That will give us 180, which is still a deferred tax expense. So these are deferred tax expense. And then here we have 600 times 30%, which is negative 180. A negative figure we have said is a deferred tax income. What about here? This will also be 540, which is still a negative. So this is deferred tax what? Income. Deferred tax income. So therefore, that what was required as far as that question is concerned, the computation of the deferred what? Tax, which I have said can either be a deferred tax income or a deferred tax what? Expense. So therefore, that is it as far as that particular small question is concerned. But equally what you have agreed, make sure you attempt the other questions. April 2023, question 5A, and then May 2018, question 1B, which are theory questions. But equally, I've said that if you have a challenge, make sure you acquire this revision kit and you try to, or basically you check on the solutions for the same at the back of that particular book. So that brings us to the end of that subtopic on income taxes. Let's meet in our next class as we look on the other subtopic still in topic number 1.